Welcome to the Live Truly Free podcast, where we provide fatherly guidance to entrepreneurs at any level of their journey. Hi, I'm George Black, and this is AJ. Are you ready for this week's adventure of building great companies and discovering the Live Truly Free lifestyle for entrepreneurs? Awesome. Let's get started.
All right. So, George, today I kind of wanted to ask you about something that I don't think a lot of people put too much thought in when they go to start a corporation. I know I definitely didn't. And this a little bit ties back to one of our previous episodes with the ready, fire, aim, or the ready, aim, fire approach. I feel like everyone just overlooks this first very important step because it almost seems like some type of formality. But I have a lot of questions when it comes to forming your company, the differences between an LLC and a corporation. How do you bring in different owners? What happens if you have losses, partner capital accounts and taxes and all that stuff? Like, what are all the implications of forming a company that I think people aren't quite aware of when they first start one?
Yeah. Okay. That's great. Today, let's get into that because I want to talk to you about those things no one ever tells you.
Yeah. Like no one told me them.
You didn't know those things when you formed your corporation, right?
No, I kind of just figured them out as I went.
Right. And then you get to the tax form at the end of the year and you go, what's a capital account?
Yeah.
All right. Yeah. So guys, just a quick little disclaimer here. We're required by all of the governing bodies to no, we're not really. But seriously though, what we want to do is help inform you so that you have a better conversation with your tax professional, your legal professional, really both. We're not providing any kind of legal or tax advice or anything like that. AJ and I, we don't have any letters after our names. We're not licensed by anybody. We're just doing a podcast. Okay. So,
yes.
Right. Yeah. So let's kind of focus all of that down, AJ, too. I think probably what no one ever tells you is about being in control of your corporation and how does all that work?
And kind of the benefits of having control and why you need that control. Like why someone should have control. Like even though a lot of people, I feel like when they get into partnerships, it's like, oh, we're four best friends and we're going to start this company. Everyone will be equal. We'll always come to the right decision together and we'll always work well and it'll all go together well.
So I'm going to tell you, comes from years of not only my experience, but in my experience leading with other companies. And don't ever, never, ever, never, ever be 50-50. And don't take the minority spot. Don't be less than 50, and don't be 50. So you got to be 51 or more. The stories, oh my gosh. So there's one, okay, so there are these three men and two of them are their brother-in-laws, and okay. They're the money guys in this deal. But they bring in a third guy who's going to run it. He's the general manager guy, and it's in another country. It was very complicated to set this whole thing up.
Yeah, it sounds complicated.
Yeah. So there's a whole international thing and stuff like that. I'm brought in to lead all the financial stuff. Okay, but I'm not part of the partnership, and even though there's multiple layers of corporations and foreign corporations and blah, 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 it's still basically a third. Now, what most people think in that is, well, look, it's my brother-in-law, we'll vote together, that sort of thing, so we've got control of the general manager and he can't. Well, that's not how it turned out. So the partner I'm working with is, I've been working with him in another corporation and stuff like that. So he and I have a very good relationship. And his brother-in-law, we'll just call the brother-in-law, and I just got to know him. And so what ends up happening is I put together these financial projections and things like that, and I show them that if they don't do a course correct, they're going to lose everything. And my guy is saying, you got to listen to George because George is right. When it comes to this kind of stuff, I've seen him over and over and over again. He's right. Well, the brother-in-law sided with the general manager.
Oh, no.
Voted my guy. And they have to put more money into this thing, and they lost millions. I don't want to toot my own horn, but I was right. And
Hmm.
circumstances didn't play out exactly like I thought, but because of the way things did play out, my projections were fulfilled. And they didn't make the course correction. And I had a remedy, I had a solution. They would have lost $100,000 instead of millions, and the
Hmm.
business would still be going today.
And so he was put in that, your friend was put in that position because, so you brought up a key point where it was they had to put more money back into the business. So that makes me interpret now that your friend, he was the minority stakeholder, or at least he didn't have the majority to overturn these two. And when these two said we're going to double down, that friend had a decision to make. I could either get diluted and lose my equity, or I have to match what they're going to put in.
Except for one small thing. Well, there's two. Actually, they're not small, they're huge. There's another problem in this thing. The general manager was a sweat equity partner. Okay, so I've got
Oh,
never. It's still part of one, but not only should you not be 50-50, but don't ever partner with someone who's got sweat equity and you've got money in the deal. If everybody's sweat equity, fine. If everybody's got money in the deal, fine. The problem was they had to keep funding the losses with the hope is not a strategy, but they had to keep funding the losses. So there was no dilution. He wasn't going to be allowed to be diluted. And it's family. Oh my gosh. It's like, ew.
yeah, that's the worst situation you could have. Makes Christmas awkward, Thanksgiving's awkward, and
You got it. You got it. This is so the thing is that, and so my guy knew this was not a good deal to get into. In other words, the structure of it.
yeah,
And he had crawled all over this thing, and we both thought there was money to be made in this deal. This could be a real money maker. But because of the unknowns, we couldn't control it.
yeah.
I tell you, I know my guy would have said, follow what George says. Let's take the small loss now, remedy that, and then we'll slow this thing down and get it profitable. These guys were going for the big elephant to go turn this thing into this huge thing. And it was one huge crapshoot, and they lost. And they lost my guy's money in the process.
Yeah. And I think there's the reason people are willing to, he knew it was a bad deal, but the reason people are willing to hop into that knowing it's a bad deal is because I think we naturally underestimate the likelihood of bad things happening. Like when he initially got into that, he's like, he thought the business was going to work, so he was willing to accept that, oh, if it doesn't work, things get ugly, because he's like, oh, it's going to work though, you know? So it's almost placing that bet it's going to work more than it won't work.
That's a really good point. I mean, nobody gets into a business thinking it's going to fail.
Yeah.
But you're right, and that's why if you can't make decisions unilaterally, you can take other people's input. But if you're the key guy, if you're the key leader, well, in this deal, the brother-in-law really wasn't the leader, but he looked like the leader. The general manager was driving the ship, so to speak. But my guy, he really knows what's going on. He's got the business savvy and business strategy.
Mm-hmm.
You don't want to be in that dynamic at all, ever. And I'll give you a little side story to this, and this is actually the big point on all of this is the thing about 50-50. So I have come to find out from a person who's been to numerous conferences on structuring partnerships, like in dental practices. Okay. So just hear any kind of like medical practice kind of thing. And they say be 50-50. Well, the problem is that you can share profits 50-50, no problem. But you can still maintain control of the business. And you want control of the business side of the business. Most people, when they hear 50-50, they're not thinking about control, they're thinking about dividing profits.
Yeah. How could you divide the profits 50-50 if you don't divide control 50-50?
You've got those options inside an LLC, and that's the way you would structure it. Is you would do it with an LLC, and so you can have a manager, and the manager doesn't have to own anything.
Okay. And that manager is the one who gets to make final say.
Manager is the only is needs to be the leader. Okay.
Yeah.
So in other words, like and I've had, we can edit this out. But I'm gonna go into the weeds just a touch here.
Okay.
So the thing is that like let's say you and I want to do an LLC, okay? And we want to split the profits 50-50. So your corporation and my corporation both put in the money to start the business. I go, but I'm not doing this deal unless I'm the managing partner. And I've got another corporation and I'm going to make that corporation the managing partner. I've had discussions with attorneys. You could either do it as an individual. I could do it as the individual, or I could do a corporation. I just prefer layers of corporations.
Okay.
And again, discuss this with whoever is advising you legally. But that's the way you can divide the profits, but you don't have to give up control.
That makes a lot of sense. And that's a good thing that you pointed out, because I think it's a common misconception that people think 50-50 means we both split the profits evenly. We're going to both be doing even work, so we should both get an even amount of pay. But really, the one with the more business sense, the one who's really going to be your leader, who is getting you started, who this thing doesn't exist without them, they need to be in control, because otherwise, why would they do it?
Right. So let's create the scenario where, let's say you and I both have an idea, and we're both in lockstep together on this thing. Okay. And we're like, look, both of us are the leader. Okay. We still need to pick one person. And if we don't trust each other enough, you can't write enough documents, which I could tell you a horror story about that. You can't write documents to build trust.
Yeah.
And so, in other words, let's say we go down the route, let's say we put all this together, let's say we're 50-50 and all of that. Well, the problem is that, let's say we fall out with each other. And I go, fine, AJ, you just take the company. You're going like, hell, you're letting me. No, you're not leaving. And you can block me. You could keep me from opening bank accounts or credit lines. You could keep me from even filing the tax return by not signing it.
Yeah. That's if I'm in control of the company.
No, that's if we're 50-50.
Oh, okay.
You see, if you control half and I control half and we're equal, then it takes both of us to open a bank account.
Yeah.
It's both of us to sign a check. It takes both of us to transact the business of the company. I can't engage in any business. I can't engage in any contracts. I can't sign my tax return because it's going to take both of us.
Got it.
Now, you might designate, well, George is the signatory on the tax returns or something like that. But if you put together no rule set, that's like,
if you don't put together the rule set, like you just said, it always gets messy at the end. And I just think people don't think from the beginning, what does the end actually look like? They have this vision, it's a lot of money, but they don't know like what it actually looks like, and the problems that partners can create on the exit of a company.
All right. So that's point number 2. Have an exit strategy. If you've got more than one partner or owner in the business, you have to have an exit strategy. So here's the deal. This is a true story. Everything I'm telling you is a true story. So there's a guy, just like you said, you got 4 friends. This is a guy. So this guy's been in business 30 years or something. So this guy, he's been around the block, and his buddies have too, and they all get excited and they all put in, and he gives everybody a piece of the company. It's like walking into a room that has one door, except when everybody gets in the room and you close the door disappears. You can't leave. It would be easier to divorce your spouse than get out of that partnership. And I'm not making this up. Now, yeah. Here's the thing about my friend. Not everybody was an equal shareholder, and he had control of the company. He did that right. He had control. And he was putting in all the money. So there's a 10% guy who's a sweat equity guy. Remember the first rule, don't ever be 50-50, and don't have sweat equity and equity mixed. All right. That's kind of 2 rules, but we're going to call it 1. But here's the thing, is that now the 10% sweat equity guy feels like he should have more because he's put in so much work. But
Oh, no.
how do you value? Well, ever watch Shark Tank? Have you ever heard him say, I'll help you for 10%? No, they give them money. For 10%, I'm going to give you money.
Yeah. They do say there's the shark premium though, that you're going to give up a little more equity for their money, but the point still remains that they
It's
pay
based on the
you
money.
because that's how a cap table actually works. It's based on the financial contributions you've made to the company.
How else are you going to do it? So what is this 10% guy's value? Is he worth? He thinks he's put in $60,000, let's say. Okay. Well, how did he come up with that? Here's the other problem.
So would you say, actually, before you get there, would you say you should value that person's time like in writing beforehand so that you say, okay, every hour you put into this company, we give you 20, like that's equal to a $20 contribution or something like that. But then eventually you get to unlimited, I imagine, if they work for the company for like 10 years.
No, it's no. Don't. If you don't put money in, you don't own a piece of the company. Do you think that would work at Apple Computer? Hey, I'll just work for you guys, and
I get a share of stock per hour.
So let me tell you this. So I've led a whole bunch of companies and stuff like that, right? I will tell you this over my lifetime of experience. The companies I wanted a piece of action in would not give me one. And the ones I didn't want a piece of action were more than willing to give me a piece of the action.
Makes sense.
I'm like, yeah, I don't know, because I would be as stuck with them as they are with me. Because here's the thing. Let's say I put $1,000 in AJ Inc., okay? And you happily take it. You are stuck with me forever.
Yeah.
Unless you have an exit strategy with some sort of formulation to buy me out, you're stuck with 1% George. Oh, you could dilute me to nothing, but so what? I can still be I still got to have shareholder meetings. You're going to have to do minutes. You're going to have books. You're going to have audits. You're going to have to do all this stuff to satisfy the 1% jerk.
Yeah. And if I don't do all of that, then you can get rid of me as a CEO. And
well, who's going to sue over $1,000? But multiply that by 100, multiply that by 1,000, and you get the picture.
Exactly.
So you want to have that entry when you come in to be very, very clear. Here's how you can come in. Oh, that's the exit door right over there.
Yeah, exactly.
And since I'm in control of the company, here's how that's going to work.
Mm-hmm. So it's like when you're forming your company, don't just think, what do we have to do to get off the ground? Like, actually take the time to think, what does this look like at the end? What does it look like at the middle? Aim before you fire. And
well, and here's the thing is nobody tells you what we're talking about.
Exactly. Because everyone thinks of formation as just that's just the legal wumbo jumbo that you got to do.
Right. We just file with the Secretary of State here in Texas is the way it works in most states. You just file the corporate documents, pay the fee, and boom, here you go.
Yeah.
All right.
People think of it as just checking a box, when in reality, you actually just built your house that you have to live in for the entirety of the life of the corporation.
You have to plan. You have to go in the event of a business divorce. What's going to happen? How are we going to sort this out? Oh, and another good one is, well, we have an arbitration clause. That's like saying, oh, well, if we want to get divorced, we'll just go to court. That's not a plan, you know. and here's what makes this problematic is it's really hard to aim at what you don't even know is out there to get you. There's a few guys out there like me, maybe, who understand, who've been through this. Anyone who's been through it totally gets it. But I have one other thing that, so you asked at the very beginning, you were talking about, you know, LLCs and corporations and all that sort of thing.
Yeah.
You want to file as a sub-S corporation. Absolutely. Okay. Now, got to explain that. The sub-S filing is not a corporation you form. It's an IRS letter that allows you to file as a sub-S corporation. This is especially true if you are a single member LLC. So let's say, AJ, you've got this great business idea and you form an LLC. File sub S, because otherwise you'll be treated as a sole proprietor. And let me tell you guys, sole proprietor, what happens is 100% of the income of the business flows through on your Schedule C, and it's taxed at the full FICA and Medicare rates for both sides, not just the business side, but you're going to pay your half and the business half, which is 6.2 times 2, 12.4 for FICA, and 1.45% each side. So that's 2.9%. So that's another 15.3% in taxes. That's not even
just for self-employment tax right there.
That's the self-employment tax. So with the sub S, I can control and pay myself a salary. And I've forgotten this, and I'm not fresh on these rules, but as an LLC, you can't pay yourself as a member. And I'm not sure about if you're an LLC as a sub S. I don't know on that. But because the rules have shifted and I don't keep up with the details like that.
Yeah.
But here's the thing. Okay, so oh my gosh. This was a professional accountant put this friend, another friend, different friend than the previous two.
Okay.
In a corporation, a C corporation. So a C corporation pays the taxes. Now here's the problem with the C corporation. A lot of people know this, is that if you want to pull money out, there's only two ways. You can do it through payroll or a dividend. And you, as an individual, have to pay dividend tax on the dividend.
Yeah. And that's higher than the personal income tax usually, right?
Well, it may or may not be depending on your tax rate.
Yeah.
But you're paying C Corp and S, so an S Corp flows through. So in other words, it flows through to the tax rate of the shareholder, whatever your personal tax rate.
And that was one of the distinctions I wanted to point out, because I also don't think a lot of people know this, is that an LLC does not exist to the IRS. The IRS is going to either tax you as a corporation or as a pass-through entity, which you get to choose as an LLC which one you want to get taxed as. But an LLC doesn't have its own tax filing status with the IRS.
That's true. So how does an LLC file? If you've got two members in an LLC, two or more members in an LLC, and by the way, your spouse doesn't count. They file as a partnership. So they file on a partnership return.
Yeah.
And so it's treated as a partnership. And yeah. I mean, it makes sense in some things like real estate, for example, but an LLC, actually, if you're going to do partnerships, do it as an LLC, not as a partnership. But the thing is that's why you want to be a sub S, because then you can control how much you take in salary and how much you just take in distributions, which you paid at the regular tax rate, whatever your
exactly
particular year.
It gives you a lot more freedom to control how you're going to be taxed.
Oh, so I never finished the story. Well, let me go.
Yeah, sorry, I cut you off on that one.
So let me just tell you the horror story of all of this done completely wrong by a longtime CPA accountant for a friend of mine.
Okay.
I met him. He was in a C Corp, and they paid him out of his corporation a 1099. And the 1099 goes through on your Schedule C like a sole proprietor, but he owned the company.
Oh, no.
And so he had a banger year. and I'm like, okay, we can't convert. You can't convert. We could convert it later. We could convert it in the next tax year, but the tax year that he had the banger year, we weren't going to be able to convert. And so what we did was very complicated. But we started accelerating depreciation write-offs, all kinds of things, and controlled how much he got in the 1099. So we measured all of this. In the end, I'll just tell you the number. Saved him over $50,000 in taxes. And I will tell you, that was on like net income of $400,000 or $500,000.
Oh, wow.
I mean, a huge amount of taxes saved. And you go, well, that's only 10%, George. You're like, no. When you looked at the numbers and you saw this was avoidable. If he was set, so the next year we set him up, he's now a sub S and he's got himself on payroll and blah, blah, and he's operating just fine. but he doesn't have the double taxation. He doesn't have the C Corp tax, so we just simplified it. Point of the story is just because you're dealing with a professional may not be the best advice.
Yeah.
I don't
It's just so easy to mess up, but so hard to get out of when you do mess it up.
Yeah. And see, when he started this number of years before, he wasn't making much money. And this may have been the accountant going, oh, well, we want to trap the losses and make this a tax shelter or something like that. I mean, there might have been some bizarre reason, but there was never a plan for him to make a lot of money at it.
Yeah.
From a tax standpoint.
Mm-hmm. So to kind of wrap us up here and summarize what we've told our three big things in incorporating and the things that you need to know or at least be aware of before you form your business. Number one is you want to be in control of your corporation. You don't want to be 50-50. You don't want to be a minority partner. You don't want to have any sweat equity partners unless you just want to be along for the ride with how your company goes. If you actually want to control the company and can be in control of your future within that company, you need to be in control of the company. Number two, you want to have an exit strategy right when you get into it. You will just put as much time as you do into starting the company as you do into thinking about how is it going to unravel at the end for good or for if things go well or if things go bad.
Oh, can I add something to that?
Of course.
Here's what most people think. Well, we'll sell the company and we'll just split it on these percentages. Well, you got to have a buyer. You've got to have a successful company. Oh, that sounds great.
Exactly.
What happens if that doesn't happen? What if nobody wants to buy your business?
Exactly. Which in some cases might be the likely scenario.
Yeah.
You might
Yeah, go check the statistics on that.
Yeah. And then our third point here, file as an LLC and as a sub S. Not as a C corporation, not as a partnership, LLC sub S.
Well, actually, I would just say file as a sub S because like in Texas, for example, so I don't know every state out there, but in Texas, for example, you file as a corporation. Okay. Then with the IRS, you elect to be a sub S. Honestly, yeah. I prefer the corporate structure versus the LLC structure, which is the LLC is more the partnership structure and the corporation is a corporate structure. So you have shares versus partners. And yeah. I just personally prefer that. So you would actually technically, when you file a corporation in Texas, it's technically a C Corp unless you get the S Corp election.
Okay.
Yeah. So I'm not advocating for corporations or LLCs or partnerships or either one. I'm just saying be a sub S, and you can only be a sub S in an LLC or a corporation.
Exactly.
A quick reminder on the disclaimer is that we're just doing a podcast here to give you some information, to arm you with questions, to go talk to your tax professional, your legal professional, any of your other professionals out there. And we're not licensed, and we're not current on current law. So don't just hear this and then take this and go seek professional advice. And here's why, because your situation is going to be different and every situation out there is different. So be aware of that and get it for your specific situation. Should you be in partnership with your brother-in-law?
Thanks for listening. If there's a topic you'd like us to discuss, email us at podcast@livetrulyfree.com. And please help others find this podcast by rating and reviewing this show. And until next week's episode, may you live truly free.